Mientras tanto, pues saludamos al próximo gestor internacional. Nos acompaña Arnount Van Rijn, es especialista de inversión multiactivos en Robeco. Arnount, thank you so much for having us these minutes. En estos momentos creo que no estamos escuchando a Arnount. ¿Hay algún problema con el sonido?
No, I'm here. Hi.
Hi, Arnount. We have had a little problem with the sound, but it's perfect now. Arnount, Eurozone downturn deepens, making recession more likely. We've seen composite PMI fall to 47.1, less than expected, but private sector activity contracted for a fourth month in October. Is the recession inevitable?
Yeah, well, we do think that particularly in Europe, recession is inevitable. In the US, there is still a bit of a chance that they might avoid that, but that will be on the margin. Fact of the matter is that cyclical stocks will see a downturn in earnings, and we think that there is still a little bit of downside to go there in terms of expectations for those earnings, and they will need to come down a little bit further.
Ships is your investing approach to survive a recession. What makes these companies attractive to investors?
Not necessarily attractive. I just highlight that the most deeply cyclical stocks, which there are, so computer chips as well as shipping companies, have actually seen already huge downgrades of earnings, and they may well be there already in terms of how far their earnings need to be cut. So expectations there are already fully pricing in that recession that you're talking about. So I feel that the downside for these deeply cyclical companies actually is not that big anymore. Rather, there is more downside in the so-called more defensively positioned stocks or the growthier stocks that will also inevitably be facing more of a recession, as a lot of them depend, for instance, on advertising revenue. So that's why it's an interesting situation now that those most deeply cyclical stocks may actually be the least vulnerable when the recession is coming, because they've already gone through a very bad whipsaw, essentially. Because when COVID came, of course, the major surprise then was that suddenly people started ordering goods, and a lot of ships had to sail from Asia to Europe and to the US. And also there was a lot of demand for computer chips as people were loading up on the working from home equipment. But then, now that that's all done and recession starts to bite, you basically see a whipsaw back, and that's where we've first seen the demand already diminish. And these companies have been in trouble for a while already, and seeing their rates come down quite aggressively. The fact of the matter is, though, that the industry structure has improved quite a lot. So there's been a lot of consolidation, both in the chips as well as in the ships. So there's fewer competitors now, which means that now that the demand is falling, they can actually still maintain a decent level of pricing, albeit lower than before.
It's really interesting, the path of these companies, as you said. Are equities at this moment more appealing than fixed income?
Well, that's a difficult question to answer here. We do believe that there are opportunities, particularly on the high yield side of fixed income, because there the spreads have reached reasonably healthy levels of 5 to 6%. And on top of that, of course, the interest rates have also come up, particularly in the US, meaning that for a lot of high yield companies, you can get 9 to 10% yield, which we find particularly attractive, and probably actually more attractive than equity markets. So we have in our portfolio allocation now an overweight for high yield bonds, for instance. But on the other hand, we're neutral for equities, as we believe that the current short-term sentiment, and this is really very short-term, is so depressed that a bear market rally, and maybe we're in the midst of one, is quite likely.
And last but no less important, will we still see rises in the stock markets despite the recession?
Yeah, so that's what I referred to earlier, that the earnings downgrades will still be coming for many stocks in the equity markets, and that won't be a favorable environment for equity investors. So we're in that slowdown phase where you see both the earnings per share come down, as well as the multiple, i.e. the PE ratio on top of that, come down. So that longer term doesn't bode very well for equities in the next 12 months or so. So we don't feel that the bear market is over, but we do believe that there is in the near term scope for a bear market rally.
Arnount Van Rijn, thank you so much. It's been a pleasure.
Thank you.
Nosotros nos quedamos, por tanto, con estas cuestiones. Preguntábamos ahora si vamos a seguir viendo subidas y nos decía, bueno, lo había abordado en la primera respuesta cuando hablábamos de esas probabilidades de recesión. Pues sí, vamos a ver probablemente un entorno favorable para los inversores de renta variable el año que viene, a pesar de esos, de ese entorno de recesión, tanto en Estados Unidos como en Europa. Y decía que su expectativa es que los mercados ya han puesto en precio esa recesión, que ya han descontado ese escenario. Vamos a aprovechar para hacer una breve pausa y volvemos enseguida.